the banks are going to custody Bitcoin. Bitcoin has gotten through its riskiest period. The accounting has been corrected. There's now only 450 Bitcoin a day available for sale by natural sellers. That's the miners. At this level, that works out to about $50 million of Bitcoin available for sale every day. If that $50 million is bought, then the price has got to move up to find any seller that's price sensitive. I think when Bitcoin rallies, if it surges to 500,000 or $1 million, then maybe we could talk about it crashing down by $200,000 a coin. But at the current price levels, it only takes $50 million to turn the entire drive shaft of the crypto economy one turn. And you've got the Trump media organization announcing $2.5 billion. You've got GameStop announcing $500 million. You've got my company that's raising billions and billions of dollars. So the writing is on the wall. Bitcoin's moving higher.
The financial world is in the middle of a quiet revolution. What once seemed radical is now becoming the new norm. Traditional investing playbooks are starting to crack under pressure from inflation, monetary instability, and public distrust in fiat systems. Meanwhile, Bitcoin is no longer just an outsider's hedge. It's being reshaped into a cornerstone of long-term strategy for everyone from sovereign states to legacy institutions. At the center of this shift is Michael Saylor, whose conviction in Bitcoin is nothing short of historic. In his latest remarks, he didn't just defend Bitcoin from critics warning of another crypto winter. He doubled down, predicting a future where Bitcoin crosses the $1 million mark. For Saylor, this isn't wild speculation, it's math. With only 450 new Bitcoins entering circulation daily and institutional buyers flooding the market, he argues that upward pressure is inevitable. MicroStrategy's own accumulation, now totaling over 582,000 Bitcoin, proves he's not just talking the talk. While Michael Saylor kicks things off with hard math, Cathie Wood takes the baton, arguing the price target is just the headline. The real story is a debt-bloated world where money velocity stalls and savers need a new refuge. For her, Bitcoin isn't a moonshot, but a monetary life raft. Stick around as we bring you more clips from Cathie Wood's explosive interview to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
Now let's go to monetary policy, and I'll show you some of these charts. But in terms of thinking about Chairman Jay Powell's testimonies recently, he's really focusing on core consumption and core investment, and not looking at trade, inventories, government spending, and some non-core consumption and investment. So, and in the first quarter, while real GDP was negative, 0.2%, this measure of core that Chairman Powell is focused on was up more than 3%. Now, if you take out everything that hit GDP, of course it's going up. Well, in the second quarter, according to GDP Now, it's going to slow down, that metric is going to slow down to 2%. But core investment alone is dropping, down 2.2%. Capital spending is getting hit. Again, companies are pulling back until there's more certainty. And so I think that measure will give Chairman Powell pause, especially if inflation remains well behaved despite tariffs. And what we have seen recently is that companies have been taking the hit more to their margins than trying to get pricing through. And why would that be? Well, the consumer is fed up with high prices, and we're seeing a lot of companies report increased prices, but unit growth dropping. And that's in the necessities space as well as in the luxury space. So I think companies are changing their behavior a bit here. And you'll see when we go to the charts, it seems as though the high yield spread is saying the coast is clearing here for a nice recovery when we have more certainty from the tax policy and tariffs, of course. On to economic indicators. Well, Employment Friday, something for everyone, as has been the case in most employment reports over these last few years during what we've been calling this rolling recession. This one was no different. You had non-farm payroll employment up 139,000, which looked better than the 125,000 expected. But when taking into account the 95,000 in revisions, that was a disappointing report. And it's also important to remember that nearly 100,000 of those 139,000 were due to the so-called birth-death ratio of businesses, so new business openings, and those get revised. So I think the employment numbers are going to be revised fairly significantly when we look backwards in time. They revise those on that basis, I think, every 5 years. The other thing that we learned is that the diffusion index for employment is right at 50%. So half of the employment categories are increasing and half are decreasing. That's down from 80% increasing at the peak in 21-22. And I think 70% compared to the peak in 2017-18. So quite a bit below that. We also saw household employment, and I don't believe this number at all, but down almost 700,000, and the labor force down almost 700,000. That's flaky. I'm sure that's there's some mismeasurement there. And we had, besides the number of industries showing declines, we saw the participation rate dropping here. So that is also something the Fed pays a lot of attention to. When all is said and done, when you tally it all together, including the 0.4% average hourly earnings increase, income is fine. But it's just dispersed. It's been skewed, as we know, towards the higher income level, and that skewing probably is continuing as we move toward the end of what we're calling this rolling recession. I'm going to spend a lot of time in the charts, and I'm going to start with the charts now on housing, but let's review just a few of the things I've mentioned. So on this first chart, you can see the deficit as a share of GDP, not seeing any improvement yet. And Scott Bessent has committed to, where you see the X there, getting this to 3% as opposed to nearly 7% or 7.5% over this administration's tenure. And we think it's going to come about more through real growth accelerating, and we think that productivity-led growth will be very powerful in this regard. And of course, there are some efficiencies that are being built into this bill, however much Elon Musk does or does not like it. And the reason Elon does really focus on government spending is it is taxation, one way or the other. We're going to have to pay this through taxes now, taxes in the future, or the cruelest tax of all, inflation, inflating our way out of the debt. And if anything, we think deflation is where we're going here. And so this debt will be very difficult to service if we do go into a deflation unless unit growth really booms. And we actually think that's possible moving into 2026. So on the next chart, I mentioned corporate tax rates. You can see here, X marks the spot, where the corporate tax rate would go if if there was immediate expensing of equipment and structures. And you see, you have to go back really to the 40s, the late 30s and 40s, to see a lower effective tax rate. So that will be quite an accomplishment if and when it happens. Here you can see money supply. The growth rate has rebounded after nearly a year and a half of negative in terms of the level falling. And if you take a look at this chart, which goes back to 1960, you'll see that where we are with monetary policy now, or money growth, is at the low end of a range. The range was lower in the early 90s as Chairman Volcker and then Chairman Greenspan were trying to squeeze inflation out of the system. But other than that, it's rarely been lower than this. And if we're right that the velocity of money is slowing down based on all of the uncertainty out there, tariffs, tax bill, government spending, and so forth, then this I think the number is roughly 4.4% growth on a year-over-year basis, is lower than nominal GDP growth is right now. And if the velocity of money is slowing down, declining as well, that's going to be another pressure on GDP. So we do think we're entering the last leg of this rolling recession. I have no idea if we'll actually see another negative GDP quarter, but we do think the velocity of money is arguing against a very strong GDP growth.
The economy right now feels like it's stuck in a holding pattern, moving, but cautiously. While headlines point to modest growth or decline depending on the metric, the real story lies beneath the surface. Fed Chair Jerome Powell has shifted his gaze toward core consumption and investment, ignoring the usual noise from trade and inventories. On paper, Q1 GDP may have looked weak, but Powell's preferred measure actually rose over 3%. The catch? That momentum is fading. In the second quarter, core investment is slowing, capital spending is dipping, and businesses are clearly hesitating in the face of policy uncertainty and rising costs. Consumers, meanwhile, are signaling fatigue. Companies aren't passing on price hikes like they used to, not because they don't want to, but because they can't. People are pulling back, and even in sectors once considered inflation-proof, like staples and luxury goods, sales volume is slumping. Employment data is equally confusing. Strong at first glance, but weaker when you dig into revisions, participation drops, and questionable household surveys. It's not a collapse, it's erosion. As for monetary policy, it's running out of breathing room. Money supply growth has barely lifted off the floor, and with the velocity of money slowing, the risk isn't inflation, it's stagnation. We're not falling off a cliff, but we're certainly not sprinting forward either. Let's watch more clips from the interview.
Now into market indicators. So starting with the dollar, we hear so much talk about how horribly weak the dollar is. Well, if you look at this chart in the context of history, and I know we go through this every time, but we keep hearing that mantra, the narrative, is just not true. If you look over the last 15 years, we've gone from roughly 70 to 100, and taking out the bubble in the early 80s, we're closer to the top end of a very long-term range than we are to the bottom. And you can see this on the next page in Bloomberg Commodity Price Index is still going nowhere. It is where it was in the early 2000s, the early 90s, the early 80s. So this is not an inflationary period. The period from 2000 to 2010 was highly inflationary by this metric, and by the measure of gold. Well, gold certainly looks like it's playing its role as a hedge against inflation, but other prices are not following gold. And here, I've been presenting this for a while. It's, to us, an astonishing chart. The ratio of metals to gold prices new low, even though silver prices, which is in the metals, have really taken off. So this disconnect between the metals to gold price ratio in the purple and the long-term treasury yield is being exacerbated here. We thought it would close with both of them moving towards one another, but that's not true. So this correlation has broken down for right now, and it's a correlation that's been in place for many, many years, even pre 2008. The correlation wasn't as close, perhaps, but it was there, as you can see. And that suggests to us that there is more weakness in the global economy than many people appreciate. It's probably in China. We do see China exporting deflation in a major way. Just look at the prices of BYD vehicles. I think they've got some now in the $8,000 range, and they're exporting to Latin America, to the Middle East, to Europe. I was in Europe, saw BYD dealerships popping up all over the place. So I think there's more of an export of deflation taking place than many people understand. Here, market indicators. So again, there are bears out there who say we're set up for another period like the late 60s to the early 80s, where this metric, the S&P price to gold, collapsed. And that was in a major inflationary period. We do not believe that's what we're going through now. And you can see there's a tug of war if you look at the recent behavior of this metric. But it looks like the test has been successful, and it looks like the market, the equity market, has weathered so much controversy this year. The tariffs, the drama around the big beautiful bill, and the Trump-Musk battle over it. So we think it will resolve on the upside here, not on the downside, and that again, I think, goes against the grain. A lot of people are out there very negative about our deficit, our government spending, and we're not happy about it either. But we can also see a lot of reasons that growth is going to accelerate thanks to the massive amount of innovation taking place out there. Another metric that is pointing in a positive direction, unlike the late 60s to early 80s, is the S&P price to the oil price, and that's reaching for new highs, which is very positive. Crude oil going down is a major tax cut for most every part of the globe except for the Middle East. And so this is a very good thing to see. And of course, this week, Saudi Arabia basically said, we want to keep our fair share. We're going to increase supply more. And I remember in the 86 period, this happened, and the oil price collapsed. And that was finally when people began to believe back then that inflation was not going to come roaring back. So let's see what happens here. Last few charts here. This is just a reminder of how much hard work the 10-year Treasury yield did over 40 years. And now we're getting back to what I would consider more normal. The 10-year Treasury yield tends to mimic the nominal GDP, and that's kind of where we are right now. If nominal GDP growth comes down, as we expect it will, we think interest rates will come down before all is said and done. But in terms of the range we would expect, we hope not to get into the 0 to 2.5% range again. That was almost heralding a very bad deflationary environment. and market signals. We lost all market signals. We want market signals, and the long-term bond yield is a very important signal. Here's the spread, the high-yield bond versus the 10-year Treasury yield. Again, closer to the low end of where it has been in the last 30 or so years. So the bond market doesn't see much risk out there. I will say I do subscribe to the risk that many people think is happening because too much money is pushing into the private credit world. And so this could be distorted, just too much demand for yield relative to supply. This could be where the bubble is. And so we'll see what happens there. And then I'll end on the Bitcoin to gold. This uptrend has not been broken. Again, this aligns with the net bullish risk-on kind of market that we think we're in, and I guess you can call the markets anti-fragile, which is a description used in Bitcoin. It's been able to withstand all kinds of turmoil, and we think the markets, the equity markets, are following Bitcoin in this regard.
The markets may be noisy, but beneath the surface, they're sending a surprisingly steady signal. Despite headlines declaring a collapsing dollar, the greenback is still near the top of its long-term range. Commodities, aside from gold, remain flat, hardly the setup for runaway inflation. And while gold has spiked, industrial metals haven't followed, hinting not at strength, but at global weakness, especially from China, where rock-bottom prices on exports like EVs signal deflation is quietly spreading. Yet the equity markets aren't blinking. Despite tariffs, policy drama, and recession whispers, stocks have held their ground. The S&P's performance relative to oil and gold suggests resilience, not panic. Falling oil prices, in fact, act like a stealth tax cut for much of the world. Combine that with ongoing innovation and improving productivity, and there's a solid case for growth, even if it's uneven. Meanwhile, bond yields are cooling, not crashing, suggesting normalization, not distress. And Bitcoin, still outperforming gold, still holding trend. If anything, markets are behaving like they've taken a few punches and stayed standing. In a world wired for volatility, that kind of calm under pressure might be the strongest signal of all. As we wrap up, do you think Bitcoin can really hit $1 million, or is it just hype? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to subscribe.